Welcome everyone. Today in chapter 12 we are going to continue the discussion of exempt income. In previous chapter we discussed about dividend and participation interest exemption, article 22 and 23. Today we are going to discuss article 24 and 25 in detail, and followed that we will review the articles in corporate tax law and the relevant ministerial decisions. So let's start with Article 24. Article 24 is talking about foreign permanent establishment exemption. If a UAE entity has a foreign permanent establishment, let's say a UAE company has a foreign branch, the income from that foreign branch, the UAE company has an option to consider it as an exempt income. There are conditions associated with that. We are going to discuss those conditions. If the conditions are met, then UAE company can, when they are filing the corporate tax return, they can exclude the income which are generated from such permanent establishment, such PE. Now, when it is possible, what are all the conditions? This we are going to discuss. First of all, let's understand foreign permanent establishment election. This is an election. When we are talking about election, we have discussed this multiple times. Election and application, there is a difference. Elections means like it is part of the corporate tax return. As long as any taxable person is eligible to elect, that person can elect. Example, we discuss small business relief. It's an election. Foreign permanent establishment exemption. It is another election. Elections, there are two types of elections. Certain elections are revocable. Certain elections are irrevocable. Foreign permanent establishment election, it is an irrevocable election. They can revoke it, but there will be replication, there will be certain adjustments required in case if any entity is revoking this election, which we will discuss that. Second point, if elected, then income from foreign PE is exempted. If it is exempted, how we are going to report it in our corporate tax return? When we are calculating our tax return, we are starting with accounting profit. Then we need to make 8 adjustments. That's what, like, after 1 or 2 chapters, we are going to start the calculation of corporate tax with all these 8 adjustments. One of the adjustment is exempt income, from accounting profit to reach to the taxable income. So, if there is any exempt income which is already part of your profit and loss account, you are going to exclude such income to derive your taxable income. If any UAE entity who are eligible and elected, that means the income from foreign PE will be exempted. Third thing, if any business who are electing a foreign permanent establishment exemption, that means they are not eligible for foreign tax credit. Where is explained foreign tax credit in corporate tax law? It is explained in Article 47. Article 47 is explained about foreign tax credit. First, let's set all the points. Then with an example, we will explain, which we will cover all the points. Then we will come back to these points again. Fourth condition, in foreign country, if a UAE company has a PE outside UAE, in that country, the income must have minimum taxed at 9%. A minimum 9% is already taxed. Then fifth thing, because it is an election, it is optional. If they want, they can do. If they don't want, they don't need to do. If elected, they are going to exempt it. If not elected, then income from PE, foreign PE, and expense from foreign PE will be part of your UAE corporate tax. You are going to consider the income from foreign branch and the expenses from the foreign branch as part of your UAE corporate tax return. Next point, once elected, it is applicable for all foreign PE. For all branches it is applicable. We cannot choose, like if a UAE company has one branch in India, one branch in Japan, one branch in US, one branch in Canada. They cannot decide like, okay, in Indian foreign branch we are going to claim exemption, US foreign branch we are not going to claim exemption. That they cannot choose. Once they have elected, they are going to claim the exemption for all the eligible branches. We told if elected, then the income is not eligible for, the income is not calculated in the taxable income. Let's say an example, if a company, that company elected foreign permanent establishment election is done in 2025, that means they are not going to include the foreign branch income or expense in UAE corporate tax return. And in 2026, they have not elected. Not elected. If a company who already elected 1 year and they don't want to elect in the next year, that means retrospectively they need to pay the taxes or they need to change the make the adjustments for the exemption they have claimed. These are the 7 points we want to discuss today to cover the foreign permanent establishment exemption. Now let's understand through an example. ABC LLC, it's a UAE company, and ABC LLC is having a branch in US, India, Canada. They have 3 branches, and in UAE the company is filing the corporate tax return. While filing the corporate tax return, they have an option to elect foreign permanent establishment exemption. What they are going to check, the basic condition is that is in US the income of US branch is already taxed minimum at 9%. If the answer is yes, then the income from the branch can be exempted through election. Can be exempted through election. This is the first point. It is an election and it is irrevocable election. If elected, then the income from foreign PE is exempted. Now, the foreign PE, the US branch or Indian branch or Canada branch, they must have paid taxes in that country, right? For their operations. Let's say in US they got let's say 100K profit. In India they got 200K profit, and in Canada they got, let's say, a 500K profit. US has a tax, right? US will tax because the PE or the branch is in US, so US is going to tax. Let's assume it is 20%. In India it is 30%. In Canada it is 25%. They already paid more than 9%, so UAE is telling that if you want, you can exempt your the income from foreign branch, you can exempt. Now, what will happen if they have elected? That they have elected means then whatever taxes they have paid outside UAE, in UAE corporate tax law article 47 is explaining about foreign tax credit. If a UAE company has paid any taxes outside UAE, in that case, in UAE corporate tax return, that tax can be claimed as a foreign tax credit. Means when UAE is calculating the UAE city corporate tax return, let's say their profit is 2 million, how the taxes will be calculated? First 375,000 dirhams, let's take simple example, 1 million dirhams. First 375,000 dirhams will be 0%. Over and above 375,000, which is 625,000 will be taxed at 9%, which will be 56,250. This is the corporate tax. Now from this corporate tax, if a UAE company has paid any taxes outside UAE, they have an option to claim the credit. They have an option to claim the credit. How that credit can be taken is that, like, let's say the US company, they paid, they have 100,000 dirhams profit in US, and in US they are paying 20%, means in US they are going to pay 20,000. In India, they have 200,000, 30% is the tax rate, that means 60,000. In Canada, it is 500,000, and in Canada, the tax rate is 25%, that means it is 125,000. So the total roughly it is 125 plus 60, 185 plus 20, 205. 205,000 dirhams already paid taxes in the foreign country. In UAE, the tax what the company need to pay is 56,250. How much is already paid? 205,000. Is that what will happen to the difference? If a UAE company has paid more taxes outside UAE, will UAE give a refund of this tax, whatever they have paid excess? Answer is no. So the maximum foreign tax credit available is equal to, this is the maximum rate, is equal to UAE corporate tax liability. If a foreign country company, a UAE company has paid taxes outside UAE, and when they are filing UAE corporate tax return, yes, they are allowed to claim the foreign tax credit, but that foreign tax credit maximum allowed limit is whatever the company is paying taxes in UAE. What will happen to the balance? In this case, 205,000 is the amount paid, and 56,000 is the taxes payable in UAE. What will happen to the difference, which is 148,750? This amount, can they carry forward to next year? No. What has happened? This is gone. So same year it need to be settled. If anything which is not settled, that means that tax is lapsed. This is the whole idea of foreign tax credit. And of course, if a company has paid taxes outside UAE, they need to keep the necessary records, because they are going to claim the credit in UAE. They have to make sure that they have necessary records to substantiate that they have paid taxes outside UAE. Now this is about Article 47, which is foreign tax credit. Now coming back to our example, they because in all three countries they have paid more than 9%, they have an option to elect the exemption. If they have elected the exemption, that means the foreign tax credit is not applicable. It should not be double, like already one side what UAE company is doing, they are telling that we have branches outside UAE and we are paying more than 9%. So we are not going to include that income in our corporate tax return. That means if that election is made, whatever taxes they have paid outside UAE, they cannot bring it into the UAE corporate tax return. If they are not electing, then they can bring the income from UAE, foreign branch also they need to bring into the UAE corporate tax. Whatever the expenses they have made in foreign country for that particular branch, that also they can bring into the UAE corporate tax return, and they are going to consolidate everything. Then they are whatever taxes they have paid outside UAE, they are going to claim it as a credit, and the maximum allowed credit should not be more than UAE corporate tax. Now we are telling in UAE the corporate tax is 9%. This is the UAE CT rate. Foreign Permanent Establishment Exemption is telling that minimum tax must be paid 9%. If this is elected, then foreign tax credit not available. If not elected, then foreign tax credit is available. Then further it is told this foreign tax credit should not be more than UAE tax. Now what is the difference? Why someone should either go for foreign permanent establishment or not go for foreign permanent establishment? How they make this judgment? One side, the eligibility is minimum 9% paid. So you elected means you are not going to consider that income. The other side, it is telling that if you have not elected, you can claim the taxes which you have paid outside UAE, but it should not exceed more than UAE taxes. Then does that make any difference? Yes, there are certain situations it really makes a difference. Let's understand through an example. A UAE company has a branch as the same example in US, India, Canada. Now let's say if this UAE company, the US branch has a profit of 1 million. Indian branch has a profit of 2 million. Canada company has a profit of 3 million. All three countries, the taxes paid is more than 9% dirhams. Now, when a UAE company is calculating their corporate tax, they have two choices. Option number one, foreign permanent establishment election is made. If it is made, that means the UAE company, let's say the UAE companies, we are talking only about the UAE part. The UAE company has a profit of 100,000 dirhams. Let's understand this way. If they made the foreign permanent establishment exemption, how their books will be look like? Their books will look like the cumulative profit, right? 100,000 plus 1 million plus 2 million plus 3 million. So total is 6.1 million. This is their book profit, accounting profit. Now they are calculating the corporate tax. When they are calculating the corporate tax, they decided we will make the foreign permanent establishment election. That means they are going to exclude 6 million. No need to consider because it is exempt income. And if they have excluded, how much is left? Only UAE profit. How much is UAE profit? 100,000. What is the tax rate applicable on 100,000 profit? 0, because it is below 375,000 dirhams. Whereas, let's understand if not elected, foreign permanent establishment is not elected. Then in this situation, how it is going to happen? We are again going to consider everything. How much is the total revenue? 6.1 million is the total profit, and that 6.1 million 375,000 dirham is 0% tax, and above it will be 5725000, and this is taxed at 9%, and the tax amount is 512,250. This is the taxes will come if the election is not made. When the election is made, then there is no foreign tax credit. If election is not made, then foreign tax credit is available. Now we are going to see how much taxes paid outside UAE. In US, they have paid, as we discussed, let's say 20%. That means they paid 200,000. In India, they have paid 2 million, let's say 30%. That means they have paid 600,000. In Canada, they have paid, let's say again 20%, which is again 600,000. In total, the business has paid 600,000 plus 600,000 plus 200,000, which is 1.4 million. Foreign tax, how much is the total foreign tax paid? 1.4 million. how much is the UAE tax? UAE tax is 512,000. What is the maximum foreign tax credit available? Which should not be more than UAE corporate tax. That means the company is going to settle whatever taxes they have paid in foreign branch or foreign country against UAE corporate tax, and whatever left, which is 884,750, is it lapsed. It cannot be carry forward. Now in this example, if they make the exemption, if they don't make the exemption, it is not going to have an impact. Now another example, let's see a same UAE company as a branch in US. Let's take only one branch. This branch has a loss of 1 million. 1 million loss. UAE parent company has a profit of 2 million. 2 million profit. In US, the tax rate is more than 9%, so they can either go for exemption or like not elect exemption. Both options are available. Now in case if they have elected, what is going to happen? The total accounting profit, how much is the accounting profit? 2 million profit and 1 million loss. That means the net accounting profit is 1 million. How much is the taxes? Again 375,000 dirhams, 0, 625,000, which is above 375,000, 9%, which is 56,250. This is the total taxes payable in this example. Now when they are electing the foreign permanent establishment exemption, how it is happening is that the 1 million profit, which is the net profit, because in UAE it is 2 million profit and US is 1 million profit, regardless your foreign PE is profit or on loss, you need to exclude that. That means you are not going to consider your US loss. That means your profit in UAE CT will be 2 million. Okay, let me explain to you in a different way. If a UAE entity is electing foreign permanent establishment exemption, they are going to exclude the foreign PE from UAE corporate tax. In this example, what is the foreign PE position? Foreign PE is on 1 million loss. If they have excluded this 1 million, then only left is UAE profit, right? That means they are going to pay taxes on 2 million. If they are paying taxes on 2 million, then how much taxes they will be paying? They will be paying 146,250. This is 2 million minus 375,000 dirhams at the rate 9%. Then they are going to pay 146,000 dirhams. This is if they have elected foreign permanent establishment election. Whereas if an entity is not electing foreign permanent establishment exemption, that means they are going to pay taxes as per this structure. That they are going to bring the US loss also into UAE taxes. So in short, a company need to decide whether the foreign PE is going to make profit or loss. If a foreign PE is going to make a profit, that means the election is made or not made, it's not going to have an impact. But if your foreign branch is on loss, that means in that situation, if you go for foreign permanent establishment exemption, you are going to pay excess tax because you cannot bring the foreign loss into UAE books. So this is the business decision need to be taken, that when we are filing the corporate tax return, should we elect this or not? It depends on whether the foreign branches are on loss or on profit. Now let's see another example. This year they decided, this current year they decided, we will not elect. We will not elect because it is the foreign PE is on loss. So we will not elect. That means the foreign branch loss I am going to claim as a loss in my UAE corporate tax return. So my corporate tax liability will be 56,250. If I elect the exemption, my tax liability will be 146,250. So 2025, the company decided I am not going to elect. I am going to bring the loss to my UAE books or the UAE corporate tax return. 2026, the US branch had a big profit. US branch had a big profit. Let's say 10 million, had a big profit. Now this year the company decided, okay, let me elect the foreign permanent establishment exemption. Here the first point, if you remember, we discussed it's an irrevocable election. Here that revocability issue will come. How it will come? The tax authority specified that if you have already claimed a foreign loss in your UAE tax and next year you want to claim exemption, first you need to go and reverse what benefit you have claimed. First you already go back, reverse what benefit you have claimed, then you can choose of changing your election. Means 1 year the company claimed the foreign loss, because the foreign branch was on loss, they claimed it. Second year the foreign branch was on profit, so they decided, no, we will not claim it. That is not going to be allowed. Instead, it is told, once you elect, then you need to continue that election, and once you elect one branch, that election is applicable for all your branches. All your branches. You cannot choose one branch I will elect, one branch I will not elect. In case if you are changing the election, if you have claimed certain benefits, that benefits need to be reversed. That is why it's a sort of irrevocable election. Now let's go back to the first point what we have written, and let's see whether we have covered all the points or not. Foreign permanent establishment is an election, and the election is irrevocable. If elected, then the income from foreign PE is exempted. We discussed already. If they have elected, then no foreign tax credit applicable. Where it is explained about foreign tax credit, Article 47. What is Article 47 told? Foreign tax credit can be claimed if any taxes paid outside UAE, it can be settled against UAE taxes. What is the maximum limit? Maximum limit should not be more than UAE tax, and the UAE company should keep necessary documents. And in foreign country, it should be minimum taxed at 9%. If not elected, then income from foreign PE and expense from PE will be part of your UAE corporate tax return. This also we discussed. If not elected, then the foreign income and foreign expenses also will bring to the UAE corporate tax return. Then we discussed, once elected, it is applicable for all foreign PE. So you cannot choose one PE I want, one PE I don't want. These are the points we have discussed so far. This is about foreign PE. Now next what we want to discuss today, we want to discuss today Article 25, which is comparatively very simple. It is about foreign company, means non-resident, who are operating ships or aircraft, operation in ships or aircraft. It can be simply explained. It's that, let's take an example, Singapore Airlines. Singapore Airlines is coming to UAE and they are bringing people to UAE, taking people from UAE. UAE authority will not tax Singapore Airlines if Singapore is not taxing Emirates. This is called reciprocity. This is called reciprocity. So, in case if a foreign company who are into aircraft or ships operation They are coming to UAE, they are making the income from UAE by operating in UAE. And if there is a reciprocity that particular country, in our example we told Singapore, is not going to tax UAE airlines, any airlines, that means UAE is also considering the income generated by Singapore Airlines from UAE is an exempt income. It is very simple. That is about Article 25. So far we have discussed Article 22 which is exempt income, Article 23 which is participation interest exemption, Article 24 which is foreign permanent establishment exemption, and Article 25 non-resident operating in aircraft and ships subject to reciprocity, the income can be exempted. And we discussed about Article 47 which is withholding tax. Now let's go to the law, ministerial decision, and see what it is written. First let's discuss about federal decree law. In federal decree law, let's go to the article. It's coming in chapter 7, exempt income, and article 22 is exempt income. The following income and related expenditure shall not be taken into account while determining taxable income. Now here let me give you one more idea about these things. If any income which is exempted, the related expenditure is also not considered as an allowed expenses. Let me give an example to you. If a UAE company got let's say a dividend from UK, and let's assume this UK dividend is eligible for participation interest exemption. While getting this dividend, UK company is incurring some expenses to get the dividend. Now the dividend income is going to be excluded from the tax return because it's an exempt income. That means any expenses associated to this exempt income is also should exclude from the tax return. So one side you are excluding the income, the corresponding expense also you need to exclude. There is only one exception to that. That exception is interest paid or interest expenses for getting the exempt income. Means UAE company invested in UK. To invest in UK, UAE company took a loan, and to this loan the company is paying interest, and that money they invested in UK, and UK company is paying dividend, they are claiming exemption. Logically speaking, the interest what UAE company is paying is against a loan which is taken to invest in UK, and the income from UK is exempt. That means this interest also should not be allowed expenses. But this is only one exception. If there is any interest expenses for getting the exempt income, that particular interest expense is allowed. And interest expenses, when we are telling allowed, it is subject to interest deduction limitation rule. We just touched, if you remember, about interest deduction rule. We are going to discuss in detail, like what we discussed, AED 12 million or 30% of EBITDA, whichever is higher. So the interest is allowed but subject to interest deduction limitation rule. Now let's come back to Article 22. The following income and expenditure shall not be taken into consideration. What are all the income and expenditure? Dividends and other profit distribution received from a juridical person, from a company that is a resident person. Juridical resident person. That means UAE company getting dividend from another UAE company. That is exempted. There is no condition specified. UAE to UAE dividends are exempted. Second exempt income, dividends and other profit distribution received from participating interest in a foreign juridical person as specified in Article 23 of this decree law. Any UAE company is giving dividend or profit distribution from a participating interest. where participating interest is explained, Article 23. Then that is also exempted from corporate tax. Third exempt income is any other income from participating interest as specified in Article 23. Fourth exempt income, income from foreign permanent establishment that meets the condition of Article 24, which we discussed today. Fifth one, income derived by non-resident person. Non-resident person means foreign company. From operating aircraft or ships in international transportation that meets the condition of Article 25. These are the 5 exempt income. Local dividend, participating interest exemption, any other participating interest that meets the condition of Article 23, foreign PE exemption, and non-resident operating aircraft or ships in the international transportation. Now let's move to Article 23. Article 23 is explaining that income from participating interest shall be exempt from corporate tax subject to the conditions of this article. We have discussed the condition. Participating interest means a 5% or greater ownership. It should be 5% or more. We discussed this already. And it should be held for at least for a period of 12 months. And that period should be uninterrupted. Then what we discussed, participation is subject to corporate tax in any other, participation is subject to corporate tax or any other tax imposed under applicable legislation of a country or territory in which juridical person is resident, which of similar character to corporate tax, at a rate not less than specified in paragraph B, clause 1 of this decree law. In short, what it is, this is called subject to tax test condition, which we discussed in the previous chapter. What is the next condition? The ownership interest in the participation entitles the taxable person to receive not less than 5% of the profit and not less than 5% of the liquidation proceedings. We discussed already 5% share, 5% profit, 5% liquidation proceedings. These 3 conditions need to be satisfied. Then this is talking about bad asset test. This is also we discussed in the previous chapter. I think the wordings are very complicated, but the concept is that the bad asset test need to be satisfied, and bad asset test, if it is failed, how to calculate the bad asset test, this also we discussed in the previous chapter. But then further there was a ministerial decision, which is Ministerial Decision 302 of 2024. What 302 of 2024 told? Bad asset test you need to check only if your participation is in a related party. Who is the related party? When 2 or more entities which are controlled common directly or indirectly more than 50% control. Any other condition prescribed by minister. Now when prescribed by minister means there is a ministerial decision. What are all the ministerial decision? Ministerial Decision 116 of 2023, which got abolished, and Ministerial Decision 302 bar 2024 is the current ministerial decision. In next paragraph, a participation shall be treated having met the condition under paragraph B of clause 2 of this article, where all the conditions are met. The principal objective and activity of the participation is the acquisition and holding of shares or equitable interests that meet the conditions. So the principal objective, the participation means it is holding of shares, which should be equitable interest. The income of the participation derived during the relevant tax period or tax period substantially consists of income from the participating interest. So all general definitions only. The concepts we have discussed already. Now what are all the things considered as participation? It can be dividends or other profit distribution. It can be when dividends and other, when dividend is coming under participation, when dividend is from foreign. Gain or loss on the transfer or sale of shares. When a company, UAE company is selling shares, then that is also considered as participating interest. Gain or loss can be UAE also, foreign also. Then foreign exchange gain or loss, when they are doing the transaction, if there is any foreign exchange gain or loss also, impairment gain or loss also. These are the 4 items mentioned in the participating interest. Most of the things we have discussed, this is all law words, but it is ultimately the concepts what we have discussed. Yeah, this we have already covered. All the points we have covered. The idea is to just to read the important point and give you an understanding, not go by word. Now, Article 24, which is Foreign Permanent Establishment Exemption, which we discussed in today's session only. A resident person can make an election. Can means it is optional, may optional, shall mandatory. Not to take into the income and associated expenditure. If they have elected, the income from foreign PE is also not considered, the associated expenditure is also not considered of its foreign PE in determining its taxable income. So, if a resident person can make this election. If they elect, they should not take it into account the following taxable income or corporate tax payable for the corporate tax period. They should not make any, they should not take it, if they elected, they should not take below items into consideration. Losses in its foreign PE calculated as if the relevant foreign PE were resident under the decree law. That means if the foreign PE has any loss, you cannot bring it. Positive income and associated expenditure, that also you cannot bring. Any foreign tax credit that would have been available under Article 47. So, if once you elected, your foreign income you are not bringing into the CT because you are considering it as a exempt income. Associated expenditure also, in case if your foreign PE is on loss, that loss also you cannot bring, and if you have paid any foreign tax credit, that credit also you cannot, you will not bring. Now then, exemption shall apply. The exemption of clause 1 shall apply only to a foreign PE that is subject to corporate tax or similar character under applicable legislation of the relevant foreign jurisdiction at the rate not less than the rate specified in UAE corporate tax law. That means the foreign PE exemption is possible only if the foreign PE is paying minimum 9% taxes in the foreign country. Article 25 is talking about non-resident person operating aircraft or ship in the international transportation. Income derived by a non-resident person from operation of aircraft or ships in international transportation shall not be subject to corporate tax where all the following conditions are met. Now we are talking about foreign company who is operating in UAE through the either way of aircraft or ships in international transportation. The non-resident person is in business in any of the following. What the non-resident person is doing? International transport of passengers, livestock, mail, parcel, merchandise or goods by air or by sea. This is the business non-resident is doing. Or the non-resident is doing leasing or chartering of aircraft or ships used in the international transportation. They are into leasing. Leasing of equipment which are integral to the seaworthiness of ships or the airworthiness of the aircraft used in the international transportation. Either they are operating the ships or aircraft, or they are leasing the ships or aircraft, or they are leasing certain equipment which is integral part of the aircraft or ship. If these three things, if a non-resident, a foreign company is conducting, in that case that foreign company, even if they have a PE, they can exclude that income from such operation as an exempt income. They can consider it an exempt income. What is the condition? A resident person that performs any activities clause 1 under of this article would be exempt and not subject to tax that is similar character to corporate tax under the applicable legislation of the country or territory in which the non-resident person is resident. In short, reciprocity, we already discussed. If the foreign country should not tax UAE company, then UAE company also will not tax a foreign company who is into operation of ships or aircraft. So this is about chapter 7, exempt income. So where we have started chapter 7, exempt income. we have covered fully. Now let's go to the relevant ministerial decision. Ministerial decision 116 of 2023 is there. This is ministerial decision 116 of 2023, which anyway got cancelled. So there is no point of discussing this ministerial decision. Let's go to the latest ministerial decision, which is ministerial decision number 302 of 2024. What is ministerial decision is talking? Ministerial decision, by the way, in UAE corporate tax law, they didn't explain about 4 million condition. If you remember, like we discussed, either 5% or 4 million. It was explained in ministerial decision. Now this ministerial decision, let's go, like, they explain what is ownership interest. It can be ordinary shares, it can be preferred shares, it can be redeemable shares. So the concept of participating interest is that the UAE company has an ownership interest in foreign company. It can be an ordinary share or preference share or redeemable share. That is what it's explained. Then the next point, it is told it should be minimum subject to tax, minimum 9%. In case in foreign country, they are not paying effectively 9% due to difference in reduction and relief in that foreign country, or they have a lower tax rates applicable to certain bracket of income. Foreign country, let's say they are not taxing up to $100,000, there is 0% tax. Now the US company, like in UAE company has a subsidiary in US, and the US company got income only $90,000. That means they will not pay any taxes in US. When after, like, when the dividend come from US to UAE, UAE is telling that okay, US has more than 9%, which is called jurisdictional tax rate. Either the effective tax rate should be more than 9%, or the jurisdictional tax rate should be more than 9%. In that case, it can be considered as satisfying the condition of subject to tax test. Here, this is about holding company. Here they have explained about 4 million condition, and 4 million if it is invested, then that is satisfying the condition of 5% ownership, 5% profit, and 5% liquidation proceedings. And it is further told that there is one condition, the acquisition condition we need to, calculating minimum acquisition cost. The 4 million dirham should not be the increase in the fair value. 4 million, we need to see the value of purchase of shares, acquisition cost. That should be more than 4 million dirhams. Then asset participation, expenses in relation to acquisition. This also we discussed. If the income is exempt, the expenses associated to that income also we need to exclude. We need to exclude if there is any professional fee, due diligence cost, any commission or brokerage, anything a business UAE company is spending and the income is exempt. The associated expenditure also we should not consider as a eligible expense for corporate tax purpose. What is the one exception? Interest expenditure incurred in relation of acquisition. This also we have discussed. If a business is making some interest payment which is related to the acquisition of the participating interest, then that can be allowed. Liquidation proceedings and losses, tax losses, this is all, everything is fine. Foreign PE exemption. Foreign PE exemption, this is also we have discussed. Qualifying foreign PE. This is about Ministerial Decision number 302 of 2024. Now, there are two guides available which are published by Federal Tax Authority. The first guide is CTG Corporate Tax Guide Exempt Income. Exempt Income, Dividends and Participation Exemption. This is also a 72-page guide. Let's quickly check. I just wanted to explain to you one particular thing in this guide. This is about dividend income. Dividend income, if a dividend income is received by a natural person, then we need to see is this dividend is received from the personal investment. Dividend received in the course of business or business activity. If it is not a business activity, that means the dividend is not received through a trade license, in simple words. And if it is received by a natural person, it is considered as personal investment and not subject to corporate tax. If they are received it through a sole establishment, they are having certain trade license to conduct the business activity, then we will check the 1 million condition for natural person. If it is yes, then that person required to consider it for corporate tax. If it is no, that person is not subject to corporate tax. If it is above 1 million, then dividend income from the juridical person, that is resident person, is exempt with no further condition. So even if a natural person is getting the dividend as part of the business activity, then also the dividend, as long as it is a local dividend, it is exempted. Dividend from foreign juridical person, it is subject to participating interest consideration. If a dividend is received by a juridical person, a company is receiving dividend, and if the juridical person is resident, then we need to directly check this condition. If the company is received dividend from another UAE company, it is exempted, no further condition. If a UAE company received dividend from foreign country, then subject to the participating interest exemption condition, it is exempted. If a juridical person is a non-resident who has PE in UAE, then in that case, is the dividend is attributable to the PE? If yes, then again it is going back here. If no, then it is not taxable. Means if a UAE company, when first we are checking whether they are resident or non-resident. If they are resident, then we are checking it is a UAE dividend or foreign dividend. If it is UAE dividend, it is exempted, no condition. Foreign dividend, it is participating interest, and it may be exempted subject to condition. Whereas if the juridical person in UAE is a non-resident person, a foreign company, then we need to check if the UAE PE, the foreign company has a PE in UAE. The foreign company, when they can become taxable in UAE, if they have permanent establishment, nexus or source income. If PE, then income attributable to PE is taxed. If nexus, then income attributable to nexus is taxed. If it's only source income, neither PE nor excess nor nexus, then they are subject to withholding tax. If a non-resident has a PE in UAE and the dividend is received through this PE, then what we need to see? We need to see whether again the same condition. It is a UAE dividend, then it is exempted. It is a foreign dividend, then it is subject to participating interest. If the non-resident has no PE, then no tax. It is not subject to corporate tax. This is what this is explained here. So it's a 72% guide. It is explained about participating interest and the conditions what we have already discussed. They have explained many cases here. Let's see this case also. It's starting, does the taxable person holds an ownership interest in juridical person? Means the question is they are having a ownership in the juridical person. If the answer is no, they are not holding any ownership, then it's not a participating interest. Then it's outside the scope of our discussion. If it is yes, then we are going to check 5% aggregate, ownership, 5% ownership is there. If the answer is yes, then we are going to check minimum 5% or 4 million is there, which we already discussed. Then here also they are explaining 4 million. Then uninterrupted period of 12 months if it is kept. Subject to tax minimum at least 9% in foreign country. Principal objective is holding. Bad asset test. And we already discussed is the participating is a qualifying free zone or exempt person. As long as if the participating interest is generated from UAE, we don't need to see the subject to tax test. That is only applicable if the participation is outside UAE. Then it is just a graph like to determine whether it is a participating interest eligible for participating interest exemption also. Conditions are same: 5% shares, 5% profit, 5% liquidation proceedings, or 4 million. Then uninterrupted period of 12 months the shares must be held. Either they need to be held or they should have intention to hold. Then subject to tax test, then bad asset test. These 4 things. This is all further explain the same thing only in different examples they have given. This is about FTA guide on dividends and participation exemption. Now the last guide is on taxation of foreign source income. This is published in November 2023. In here I just want to discuss with you again one particular scenario. Yeah, this one. This so far what we have discussed, this entire chart is covering everything. So let's discuss a bit detail on these things. First, it's a taxable person. Taxable person can be resident or non-resident. Resident or non-resident. Now, let's see first the resident person. Resident person can be juridical person or natural person. If the resident person is a juridical person, then they are subject to worldwide income. Means they are going to pay taxes on UAE income also, foreign income also. If a person is a resident natural person, then we need to check is that person is conducting business or business activity in UAE. If the answer is no, then not subject to corporate tax. If the answer is yes, the person is conducting business or business activity, then we need to check does the turnover from business activity is more than 1 million. If again the answer is no, not subject to corporate tax. If the answer is yes, then they are subject to corporate tax. What is the tax base? Where it is explained about tax base? Article 12. Subject to corporate tax on foreign income that relate to the business activity conducted in UAE. This again we discussed. If a natural person, that natural person is a resident, he is also subject to worldwide taxation. The foreign income will be taxed in UAE if that foreign income is connected to the UAE business activity which the natural person conducted. This is about resident person. If the person is non-resident person, then we need to again see juridical person. If it is a juridical person, then whether they have PE in UAE. If the answer is no, that means their foreign income is not subject to UAE tax. If they have a PE in UAE, then the income attributable to the PE is subject to tax. Only the income, it's not worldwide income, the income attributable to PE. Then why there is no nexus mentioned here for non-resident juridical person? Because nexus means immovable property is located in UAE. Only that property is going to be taxed. That's why they have not discussed anything about foreign income here. Non-resident natural person, again we are going to see is that natural person has a PE in UAE. If the answer is no, then not subject to corporate tax. If the answer is yes, then through that PE the person made more than 1 million or not. If the answer is yes, then that person is subject to corporate tax insofar the income generated from the PE. And again it is explained wage, personal investment, real estate investment, this is all subject to not considering for 1 million. UAE has withholding tax currently at the rate of 0%. I think we have discussed this in Article 45. So this is all examples on foreign source income. With this, let's wind up for today. And now what we are going to do from the next session, we are going to start the computation of corporate tax. computation of CT. In computation of CT, we are going to start with accounting profit. This is the starting point. How we need to derive the accounting profit? Accounting profit prepared as per IFRS or IFRS for SME. Then 8 adjustments. This is what we are going to discuss. Most of our part from now, we will be focusing only on computation of corporate tax, what are all the adjustment. Already one adjustment we discussed on the exempt income. We are going to discuss on the relief, non-deductible expenditure, loss transfer. In relief, there are business restructuring relief, then qualifying group relief. Many things are there. By the end of these 8 adjustments, I'm sure like you will be in a position to calculate corporate tax when you get a profit and loss statement. So this is what we are going to do from the next session. See you in the next session. Until then, bye-bye.